The silver market may have just reached one of its most important turning points in years, and surprisingly, the biggest signal isn't coming from New York or London, it's coming from China. The latest activity on the Shanghai Futures Exchange has revealed something that deserves serious attention, not because it guarantees an immediate price explosion, but because it highlights a deeper shift taking place beneath the surface of the global silver market. Welcome to Agjon Silver Update. Today we're looking beyond headlines and price predictions to focus on what the physical delivery data is actually telling us. This isn't about creating fear or chasing unrealistic targets. It's about understanding a trend that could reshape how silver moves around the world. Because when physical metal starts leaving exchanges at an unusual pace, experienced investors know it's worth paying attention. Here's what's happening. Throughout the first half of 2025, the Shanghai Futures Exchange has reported physical silver deliveries that are far above what has normally been seen in previous years. This isn't a one-time spike or an isolated event. Month after month, more market participants are choosing to take delivery of actual silver instead of simply closing or rolling their futures contracts. That difference matters more than many people realize. Most futures markets aren't designed for large-scale physical delivery. The majority of traders never intend to receive the commodity itself. They trade contracts, hedge risk, or speculate on price movements before closing their positions. Whether you're looking at New York, London, or historically even Shanghai, physical settlement has generally represented only a small portion of total trading activity. But that pattern has clearly started to change. Instead of treating silver as another paper contract, buyers in China are increasingly requesting the real metal. They want silver delivered into warehouses, not just exposure through financial instruments. The official exchange reports confirm this trend, showing that physical withdrawals have accelerated significantly throughout 2025. That naturally raises one important question. Where is all this silver coming from? To understand why this matters, we need to look at China's role in the global economy. China isn't simply another precious metals investor, it is the world's largest industrial consumer of silver. Its massive manufacturing sector depends on the metal across countless industries. Silver plays a critical role in solar panels, electric vehicles, advanced electronics, telecommunications equipment, medical technology, military systems, and expanding 5G infrastructure. Every year, hundreds of millions of ounces are consumed to support these industries. For many years, China balanced this demand through domestic mining, recycled material, and imports from overseas. While those sources shifted depending on market conditions, overall supply generally kept pace with industrial consumption. What makes 2025 different isn't just demand, it's the intensity of that demand. China continues installing record levels of solar capacity, building one of the largest renewable energy expansions in history. New solar technologies, including advanced cell designs, often require greater amounts of silver during manufacturing. That means as production grows, silver consumption can grow even faster. Now combine that rapidly expanding industrial demand with record physical deliveries through the Shanghai Futures Exchange. Suddenly, this no longer looks like normal market activity. It begins to resemble a structural shift in physical silver demand. And when the world's largest industrial consumer starts removing increasing amounts of real silver from exchange inventories, the rest of the global market has every reason to pay close attention. One reason this deserves attention is because of how the global silver market is structured. When most investors check the price of silver, they're usually looking at the COMEX futures market in New York. That exchange has long been the benchmark for silver pricing across much of the world. But there's an important detail that often gets overlooked. COMEX is primarily a futures market, not a physical marketplace. Most contracts traded there are never settled with actual silver. Instead, traders close their positions before expiration or roll them into future contracts. That system has worked for decades because only a relatively small percentage of participants ever ask for physical delivery. As long as everyone is comfortable trading paper contracts, the system operates smoothly. The challenge begins when more buyers decide they want real silver instead of financial exposure. That's exactly why China's recent delivery trend is attracting so much attention. The Shanghai Futures Exchange isn't simply recording heavy trading activity, it's seeing a growing number of participants requesting physical silver month after month. If that type of behavior continues expanding globally, it raises important questions about how much immediately available metal actually exists within the international system. To understand why, it's important to know the difference between COMEX's two inventory categories. The first is eligible silver. This metal meets exchange standards and is stored in approved vaults, but it belongs to private owners and isn't automatically available to settle futures contracts. The second category is registered silver. This is the portion that has been specifically designated and is ready for delivery when contract holders request physical metal. That registered inventory is what market analysts monitor most closely. Over the past couple of years, registered silver stocks have generally trended lower. Daily numbers naturally fluctuate as metal moves in and out of warehouses, but the broader direction has remained relatively clear. Compared with previous highs, the amount of silver immediately available for delivery is noticeably smaller than it once was. By itself, that isn't proof of a crisis. But when shrinking registered inventories are combined with rising physical demand from the world's largest industrial consumer, the overall picture becomes much more interesting. Every ounce shipped into China is an ounce that isn't sitting inside a Western exchange vault. Every ounce used in a solar panel, an electric vehicle, advanced electronics, or industrial equipment becomes part of the manufacturing process rather than remaining available for investors. This is where another important signal enters the conversation: the Shanghai silver premium. At times, silver in Shanghai trades at a higher price than equivalent metal in London or New York, even after transportation, insurance, and import costs are considered. When that premium remains elevated, it tells us something valuable. Chinese buyers are willing to pay more because they want immediate access to physical silver. In a perfectly balanced market, traders would quickly buy cheaper silver elsewhere, ship it to China, and eliminate the price difference through arbitrage. But when that premium lasts for weeks or even months, it often suggests that physical supply isn't as abundant as the paper market alone might imply. In other words, the futures price doesn't always tell the entire story. The market for actual bars can behave very differently from the market for contracts. When we connect these pieces together, the pattern becomes much clearer. China continues pulling unusually large amounts of physical silver through its exchange. Industrial demand remains exceptionally strong, led by solar manufacturing, electric vehicles, electronics, and expanding infrastructure. Meanwhile, Western exchange inventories remain well below previous peaks, and persistent premiums suggest buyers are still competing for available metal. No single statistic guarantees what silver will do next, but when multiple independent indicators all point in the same direction, experienced investors understand that something meaningful may be developing beneath the surface. And that's exactly why so many analysts are now watching China's silver market more closely than ever before. As we step back and look at the bigger picture, it's clear that China's recent delivery activity is about far more than 1 month's statistics. It reflects a long-term shift that has been building quietly for years. While many headlines focus on daily price swings, the real story is unfolding in the movement of physical metal. That is where experienced market participants tend to keep their attention. One of the strongest drivers behind this trend is the global energy transition. Silver has become an essential industrial metal, not simply a precious metal held for investment. Demand continues expanding across solar energy, electric vehicles, artificial intelligence infrastructure, advanced electronics, medical equipment, and modern power grids. Nearly every major technology expected to grow over the coming decade depends on silver in one form or another. The challenge is that supply has not been growing at the same pace. Global mine production has remained relatively stable for several years. Unlike gold, most silver isn't mined from dedicated silver mines. A large percentage comes as a byproduct of copper, lead, zinc, and gold mining. That means silver production can't simply increase because prices move higher. Unless production of those other metals expands significantly, new silver supply remains difficult to grow quickly. This imbalance has contributed to a series of documented global supply deficits. According to industry reports, total demand has exceeded newly mined and recycled supply for multiple consecutive years. Those shortages have been filled by drawing metal from above-ground inventories, exchange vaults, ETFs, and private holdings. That process can continue for a while, but it cannot continue forever. Every year inventories decline, the available cushion becomes smaller. Then, if industrial demand continues rising while physical buying accelerates, the market eventually reaches a point where prices must adjust to encourage additional supply or reduce demand. History shows that commodity markets rarely move gradually when that adjustment begins. Silver in particular has earned a reputation for making sudden, powerful moves after spending long periods trading sideways. Nobody knows exactly when those moves begin, and no one can accurately predict the timing. But understanding the underlying fundamentals often provides far more value than reacting to daily volatility. Another indicator worth watching is the relationship between gold and silver. For decades, investors have monitored the gold-to-silver ratio to judge relative value between the two metals. During periods when the ratio becomes historically elevated, many analysts view silver as undervalued compared with gold. As gold has strengthened over recent years, some investors believe silver still has room to catch up if industrial demand and physical tightness continue supporting the market. Again, this doesn't guarantee higher prices tomorrow. Markets remain influenced by interest rates, economic growth, investor sentiment, inflation expectations, ETF flows, and geopolitical developments. Any of those factors can create short-term volatility in either direction. That's why it's important to separate headlines from long-term fundamentals. When we connect everything we've discussed, a consistent pattern emerges. China continues reporting unusually strong physical deliveries. Industrial consumption remains exceptionally robust. Premiums in Shanghai continue signaling firm demand for physical metal. Western exchange inventories remain below previous highs. At the same time, the global silver market continues operating within a structural supply deficit. Individually, each of these indicators is worth monitoring. Together, they tell a much larger story. They suggest that physical silver is becoming increasingly valuable within the global economy, and that the balance between supply and demand may be tightening more than paper prices alone indicate. Perhaps the biggest takeaway isn't simply whether silver reaches a certain price next month or next year. It's the possibility that pricing power is gradually becoming more influenced by physical demand in Asia, especially China, rather than exclusively by futures trading in Western financial centers. That transition won't happen overnight, but trends like the recent activity on the Shanghai Futures Exchange suggest it's already underway. Here at Agjon Silver Update, our goal isn't to predict sensational price targets or spread unnecessary fear. It's to examine reliable data, follow the physical market, and understand the forces shaping silver over the months and years ahead. No single report can tell us exactly where silver goes next. But when inventory trends, industrial demand, exchange deliveries, and global supply data all begin pointing in the same direction, they deserve careful attention. The silver market has always rewarded patience more than emotion. So stay informed. Keep watching the physical indicators and make decisions based on evidence rather than headlines. The story unfolding today is much bigger than one exchange or one country, and if current trends continue, the global silver market could look very different in the years ahead. Thank you for watching Agjon Silver Update. If you enjoyed this analysis, don't forget to subscribe, share your thoughts in the comments, and join us for the next update as we continue tracking the developments that matter most in the precious metals market.